Welcome back. You're watching Editors Roundtable on CNBC-TV18. And let's put the spotlight on the tech names. They'll be first to come out with their Q4 numbers starting early April. Now, Q4 is likely to be a very muted quarter for the IT companies. Discretionary spending has still not come back. So these are the numbers that UBS is anticipating. As you can see, it will be flat to negative constant currency revenue growth on a quarter-on-quarter basis for the large cap IT names. The FY26 revenue guidance, which Infy and HCL Tech give, is also likely to be very conservative. So according to CLSA, Infy is likely to guide for 2 to 5%, while HCL Tech will be about 3 to 5%. They want to just put in some amount of buffer given the macro uncertainty. That said, UBS still expects FY26 to be better than FY25, even though discretionary spending has been delayed, the recovery in discretionary spending. So these are the numbers. As you can see, for FY26, the street is now expecting low to mid-single digit kind of a top-line growth, which will be marginally better than what the companies did in FY25, barring TCS, because TCS in FY25 had the boost of the BSNL deal. You know, the big thesis that's played out over the narrative over the last 2 months in IT is the discretionary spending, which was expected to, get revived and boost growth in FY26, that is getting delayed. But, UBS says that, we chatted with a lot of managements of IT companies, and although the macro uncertainty, the noise has increased, it's not that tech budgets have been materially impacted. So that's a positive. CLSA too says that the near-term consensus, all the pessimism is priced in, and the near-term consensus cuts seen in the IT stock is already being factored in. They remain positive on IT, even if there are tariffs or no tariffs. In the event of tariffs, they're saying we will see more cost optimization deals because clients would be hard-pressed. There will be more cost optimization deals. And if there are no tariffs, then there will be a faster recovery in discretionary demand. So CLSA's call is, if there are tariffs, there are no tariffs, IT is likely to do well. Now, year-to-date, IT companies have had a rough start. They've recovered, from the lows, but they're still down about 10 to 15% on a year-to-date basis. So does that make them attractive? Just want to put the risks on board that US could slow down materially. Right now, discretionary spending on a sporadic basis have been impacted in sectors like retail, for instance, manufacturing, where there is a lot of fear on the back of tariffs. But if it becomes more broad-based, then will it start hurting the IT sector? Let's ask Sandeep on tech. Sandeep, you've already said that tech is not a favored sector for you. Your exposure on tech is practically zero now, and you're worried about NASDAQ. The vulnerability for tech emerges from US tech and the kind of complacency that's set in. But do you think at some point of time, IT might turn, Indian tech?
Some point in time, yes. But
sometime this year or sometime, are we closer? Because
I tell you, we don't have any love or hate relationship with any stock or sector. But as of now, we have not reached that inflection point. Okay, I see, if I look at from peak to bottom, if I have to say, maybe 20-25% NASDAQ has to fall from the peak. Okay, so the fall has just begun. So my view is that maybe wait for April or so, June or so. I think you will see much more deeper correction because complacency in US was very high. Massive money flow towards these magnificent 7 so-called names. Okay, valuation-wise, they are not expensive. I agree with that part on a relative basis. But ultimately, it is like grossly overowned space. So ownership is very high. And
the tech is not on your buy list right now. What else is there?
So I think if I compare to tech, then pharma is a better number. See?
Okay. They will deliver. Pharma, you like pipes, you like some of the PSUs, particularly the energy names.
Hotels is the one sector which I generally talk about. It's a new sector which is emerging for us. We have never, so in few companies, we are nearly 5% of the companies we own. So we think this sector is going to expand. Okay, with ITC Hotel also getting listed. Like I always give example, like few years back, how reality expanded. Only DLF started, then Macrotech came, and then some much more. Today look at the basket is very large. Okay, so it gets established as a sector. I think in the consumption, since we are very bullish on consumption as a thing, I think in the consumption, if you ask me what is the best thing, I think it's the hotels and tourism. And within that, tourism is a very large thing, but there's hardly any opportunity apart from Indigo. Okay, so what is left is hotels as a theme. So I think this is an area which I like to look from a longer term perspective. It's not just 1 quarter, 2 quarters play. If I have to somebody ask me what is next 3 to 5 year story, I think these are the areas where you will get multi-baggers.
Sure. Sandeep, you spoke about further correction in NASDAQ and in the US market. In that context, we saw one dip correction in the Indian markets. What would be your guess? 10%, 15% correction is likely for Indian markets as well, given the fact that the FIs have turned net buyers now, and there is domestic supply, domestic flow, which is still very supportive.
See, my entire thesis is that India was early to peak out, okay? If I have to say that India risk-off cycle actually started in July 2024, and it was a mild risk-off, and by September, October, it was major risk-off for India, okay? And what was the situation in July 2024 for India? US was in similar situation in January 2025. Which means India is leading in terms of corrective phase, already corrected a lot.
Even in a bad phase for US markets, India can tend to outperform.
Yes, India logically will outperform the US market, not in terms of fall in, but in terms of overall performance. India should do well, and this time if you notice, last 1 month, particularly March month, India has done better than the US market. Okay, so I think I'm not negative even from the emerging market also. I think it's not about India. Whole emerging market basket looks good. Okay, see, the worry was DXY, and I think it's still a worry. If you ask me, still a perceived risk for us. But the way it has changed in terms of correction, I think money towards emerging market is also started increasing. So if emerging market as a basket, and particularly if you look at the currency movement, it is more favorable. I'm not saying the risk is completely behind us, but it's more favorable. I think emerging market as a basket has done well, and India is part of that basket, and India should do better from the current level. But you have to be very clear that we cannot live in isolation completely, but relatively we should do better.
A little bit of decoupling, but thank you, Sandeep, for joining in. I heard you'd already got the party started in Bangkok before the long weekend.
I know. We're actually planning to go for offsite next month only, and I was there for some other function.
Okay, thank you. Enjoy your long weekend. Well,
thanks.
That brings us to a close in this edition of Editors Roundtable. Thank you very much for watching. Stay tuned to CNBC TV 18 for more news and updates. Goodbye and thank you.